China's latest inflation data for October is out, and it's certainly making waves. On the surface, the numbers seem to signal an end to the recent deflationary trend, but they've also kicked off a pretty intense debate in global financial markets. So let's dive in and really unpack what's going on beneath the surface. So let's get straight to the bottom line. What we're seeing here isn't a sign of a broad, organic recovery. No. Instead, the data is pointing to a critical inflection point, one that's clearly being driven by state policy and one that reveals some very deep structural differences within China's economy. You see, the October data just blew past all market expectations, and that's what's fueling this debate among international analysts. What this really boils down to is a question about the true health and, maybe more importantly, the durability of China's domestic demand. Because these headline figures, they seem to be masking a much more complex reality. Okay, so let's get into the numbers themselves. The Consumer Price Index, or CPI, came in at plus 0.2% year over year. That's a significant beat compared to the consensus forecast, which was for a slight drop. But the really interesting story is in the details. Core CPI, which strips out those volatile food and energy prices for a clearer signal, accelerated to 1.2%. And just as important, the Monthly Producer Price Index, PPI, turned positive for the very first time this year. These are the key data points at the center of the debate. And what you see here is a sharp divergence in how this data is being interpreted. On one hand, international analysts are largely skeptical of that headline CPI figure. They're seeing it as a temporary boost from holiday spending that will likely fade. But on the other hand, there's a broad consensus that the acceleration in core CPI is the real deal, the most authentic signal we have of a genuine repair in domestic demand. So let's tackle that international skepticism around the headline CPI first. The argument here is that this positive turn isn't really a true signal of recovery at all, but more of a distorted one. And when you dig into the data, you can see exactly why they think that. The headline number was really carried by holiday-related services. Hotel prices jumped 8.6% month over month, and airfares shot up 4.5%. This holiday surge is masking deflationary pressures in other key areas. For instance, vehicle prices actually kept falling, down 1.9% year over year, which tells you there's still intense price competition in that sector. Therefore, the view that the headline CPI is really more noise than signal is quite reasonable. Relying on that figure alone would honestly give you a very distorted picture of the economic situation. So the crucial point is, we have to look deeper. And that brings us to where the real story seems to be, the core CPI. Remember, this is the metric that excludes those volatile food and energy prices. It accelerated to 1.2%, hitting a 20-month high. And this is the number that has analysts agreeing that something genuinely positive is happening under the hood. The first real engine behind this core inflation growth is the direct impact of government policy. We are seeing specific stimulus measures aimed squarely at boosting domestic consumption translate directly into pricing power for certain goods. And you can see this clearly in the numbers. Take a look, a 5% year-over-year increase in the price of household appliances. Now, that's not just happening on its own. It's a direct result of government trade-in programs designed specifically to get people to spend on these exact items. It's a textbook example of policy directly moving the needle on prices. Now, the second driver is, well, it's perhaps even more telling, and it's not widespread consumer optimism. Instead, what we're seeing is a defensive shift in spending patterns, a reaction to continued economic uncertainty. This points to what we call a K-shaped recovery, where different parts of the economy move in opposite directions. And get a load of this number, a staggering 50.3% year-over-year price increase for gold jewelry. Now, that is not a sign of consumer confidence. It reflects a powerful demand for safe haven assets amidst uncertainty, a defensive move that is a massive contributor to the rise in core inflation. The final piece of the puzzle, the final piece of evidence that confirms our central thesis, comes from the Producer Price Index, or PPI. This data provides the clearest confirmation yet of a recovery being guided not by organic demand, but by the state. The key signal here isn't the size of the number, but the direction, plus 0.1% month over month. Now, that might not sound like a lot, but it's the first time it's been positive all year. It's a significant turning point, suggesting a policy-induced floor is being established under industrial prices. But, and this is absolutely critical, this increase was not driven by a rebound in organic demand. If you look at prices for consumer-facing goods, like living materials and durable goods, they were either flat or they continue to fall. The demand signal coming from producers is still weak.
So if it's not demand, then what is it? Well, the answer lies squarely in supply-side policy. The turnaround was entirely due to state intervention. We're seeing price hikes in sectors targeted by what's known as capacity governance, which is basically the state managing production to reduce internal price wars. And you can see it right there in coal, cement, and non-ferrous metals, all of which saw price increases.
Okay, so we've unpacked the data. Now, what does it all mean? Let's zoom out for a moment and look at the broader macro implications, both for domestic policy and for the global economy. The first and most immediate implication is for monetary policy. With core inflation picking up steam and the PPI stabilizing, the consensus view is that the scope for any further easing from the central bank has significantly narrowed. You could say that the door for more interest rate cuts is now effectively closed. Secondly, from a global perspective, we have to consider China's ongoing role in the world's inflation landscape. For a while now, it has been a major exporter of disinflation. You see, even with that small monthly improvement, you have to remember that the annual producer price index is still negative, sitting at minus 2.1%. And what that means is, on a yearly basis, prices at the factory gate are still falling. As a result, China continues to export disinflation to the rest of the world through its very competitively priced goods. And all of this analysis, it really funnels down to one central strategic question. When you have a recovery that's being driven so heavily by specific policy interventions, rather than a broad-based revival of organic demand, it raises critical questions about its durability. Is this recovery sustainable? That remains the key variable to watch going forward.